What if the number in your head right now, the one you think you can afford for a house, is completely wrong? Not a little off. Structurally, fundamentally wrong. And what if finding that out after you sign is one of the most financially painful experiences of your life? Stay right here, because in the next few minutes, I am going to show you exactly how much house your salary actually buys you. And the answer is probably not what you think. Here's the core problem that almost nobody talks about before you sit across from a lender. The question a bank answers when they evaluate your mortgage application is totally different from the question you should be asking yourself. A lender wants to know the maximum amount they can legally approve you for. You should be asking what total housing cost keeps my financial life healthy, my savings growing, and my margin wide enough to survive the things that will inevitably break after you move in. Those two questions produce two very different numbers. Most buyers never realize that gap exists until they are 6 months into owning a home, feeling financially strangled, wondering why nobody warned them. So let me break down exactly where that gap comes from, because it starts with something almost every buyer misunderstands. Lenders calculate your maximum borrowing based on your gross income. But here's the thing, your gross income is not the money you actually live on. On a $90,000 salary in a moderate tax state, after federal taxes, state taxes, and standard deductions, your actual monthly take-home is somewhere between $5,800 and $6,200. Lenders calculate your limit against $7,500 gross. You are actually working with $6,000. That difference is not a small technicality. It is the engine behind why so many homeowners feel like they are constantly just barely keeping up. Now you have probably heard of the 28% rule, the long-standing guideline that says housing costs should stay under 28% of your gross monthly income. It sounds reasonable until you realize that 28% of gross is not the same as 28% of what actually hits your bank account. On that $90,000 salary, 28% of gross is $2,100. 28% of take-home is closer to $1,680. That $420 monthly difference adds up to over $150,000 across a 30-year mortgage. So what number should you actually use? Your total housing cost, meaning principal, interest, taxes, insurance, and a maintenance fund, should not exceed 30% of your real take-home pay. Cross that line consistently, and the financial margin that keeps your life functional simply disappears, and that brings us to what your salary level actually unlocks in the real market. Let me make this concrete with actual income levels. At $60,000 gross, your take-home runs roughly $4,000 to $4,300 monthly. That gives you a housing budget of around $1,200 to $1,300. At current mortgage rates, that supports a loan of approximately $198,000, meaning a purchase price of around $220,000 to $248,000 with reasonable down payments. In most major coastal metros, that number gets you almost nothing competitive. In mid-sized Midwestern and Southern cities, it works. At $80,000 gross, the purchase range jumps to roughly $267,000 to $316,000. That is the income level where ownership becomes possible, but not automatically comfortable. At $100,000, you are looking at $307,000 to $369,000 depending on your down payment. At $160,000, $500,000 homes start becoming genuinely sustainable. The salary and the market always have to be evaluated together because one without the other gives you an incomplete and dangerous picture, which leads directly to the hidden costs that blow up most first-time buyer budgets. Here's where people get caught completely off guard. Property taxes alone vary wildly by location. The national average is around 1.1% of assessed value annually, but New Jersey averages 2.2%. Alabama sits at 0.4%. On a $380,000 home, that difference is nearly $7,000 per year, or $570 per month, before you have paid a single dollar toward the actual mortgage. Homeowners insurance adds another layer of complexity. Florida averages over $4,000 annually. Some California coastal zip codes have seen major insurers pull out entirely, making coverage hard to get at any price. And then there is the maintenance reserve, the budget item almost every first-time buyer skips entirely. The standard recommendation is 1% of home value per year. On a $380,000 house, that is over $300 a month, you should be setting aside for the roof, the HVAC, the water heater, and everything else that breaks without warning. Skip that fund, and every repair becomes a high-interest credit card charge. When you add these three items together, the true cost of ownership can easily run $600 to $1,200 more per month than the mortgage payment alone. And that brings us to the final piece of the puzzle that most buyers underestimate going in: the down payment. Most people think of it as just the upfront number you have to hit. But it does two things at once. It lowers your monthly payment, and it depletes the liquid savings you built over years. Put down 20%, and you eliminate private mortgage insurance, which on a $300,000 loan runs between $125 and $250 every single month, just to protect the lender, not you. At 10% down on a $380,000 home, you need $38,000 for the down payment. Add closing costs at roughly 3%, and you are looking at nearly $50,000 out the door before you turn the key. And here's the part that creates real financial vulnerability. That cash needs to exist separately from your emergency fund, which should stay completely intact after closing. The buyer who drains everything to reach closing and then faces a $3,000 HVAC failure in month 2 is in a genuinely dangerous position. The realistic target you should be building toward includes the down payment, closing costs, and a post-closing emergency fund of 3 to 6 months of total housing expenses. At the $300,000 price point, that full number is often between $60,000 and $90,000. That is the real target, not just the down payment, the complete number that means you own the house, instead of the house owning you. Start there, build toward that, and you will buy with the kind of financial breathing room that makes home ownership actually feel like freedom.